You know that moment, it's a Tuesday afternoon, you're sitting there eating lunch at your desk or maybe just scrolling on your phone, and you see someone talking about investing, and something in your chest kind of tightens up? Not because you don't care. You care. You care a lot, actually. It's more like, you feel like you're already behind. Like everyone else figured something out at 22 that nobody told you about. And now you're sitting here thinking, well, I can't afford to invest anyway. I've barely got enough to cover the groceries and the rent and keep the car running. I get that feeling. I really do. And I want to talk to you today about something that, honestly, sounds almost too simple to be worth your time, but I promise you, if you stick with me on this, it's going to shift the way you see money in a way that actually feels calm. Not overwhelming, just calm. What happens if you invest $5 a day, starting at 25? That's it. That's the question. And the answer is going to surprise you, not because it's magical, but because it's so quietly powerful that most people completely overlook it. My name's Finn. Welcome to Finley Invest. Let's talk about this. Here's the thing about money conversations in Australia, and honestly, I think this is true everywhere. We've been sold this idea that investing is something you do after you've sorted everything else out, after you've paid off the credit card, after you've saved up a proper emergency fund, after you've got a stable income, after the kids are sorted, after. And look, there's some wisdom in that. I'm not going to pretend there isn't. But what that thinking quietly does is it turns investing into this distant, aspirational thing that lives somewhere in your future. In the version of your life where everything is already under control. The problem is, that version of your life never quite arrives, does it? At 25, you think you'll start investing properly when you're 30. At 30, you think you'll get serious when the car loan is paid off. At 35, life happens. Maybe there's a kid, or a job change, or an unexpected bill, and suddenly you're 40, looking back, wondering where the time went. And I say this not to make you feel bad. I genuinely don't. Because this isn't a discipline problem or a laziness problem. It's a psychology problem. It's the way the human brain is actually wired. We're not built to feel urgency about things that are 30 or 40 years away. We're built to respond to what's right in front of us. The rent that's due next week, the groceries, the subscription you keep meaning to cancel. The future feels abstract. The present feels real. So we keep choosing the present, over and over, without even realizing we're making a choice. But here's what I want to gently push back on today, and this is the part one really want you to hear. You don't need to have everything sorted to start. You just need $5 a day, which is one coffee, one sneaky snack from the servo, one impulse add to cart item you didn't really need. That's it. So let's actually look at the numbers. And I want to do this in a way that feels real, not like a spreadsheet somebody's reading at you. $5 a day is roughly $35 a week. About $150 a month. Just over $1,800 a year. Now on its own, that doesn't sound like much. I know. And if you just stuffed that cash under your mattress every year for 40 years, you'd end up with about $72,000. Which, honestly, isn't nothing, but it's also not the kind of number that changes your life. Here's where it gets interesting. When you invest that money, even in something straightforward like a diversified index fund, which basically means you're buying a tiny slice of the share market rather than picking individual companies, something else starts happening. The money you've put in starts earning returns. And then those returns start earning returns. This is compound interest. And I know that phrase gets thrown around a lot, but I want you to actually feel what it means for a second. Let's say you start at 25. You put in $5 every single day, and your investment earns an average return of 7% per year, which is pretty close to the long-run average for a broad Australian share market index, after inflation. Not guaranteed, not every year, but a reasonable historical average over long periods. By the time you're 65, you'd be looking at somewhere in the range of $520,000. Some calculators put it a little higher, some a little lower depending on the assumptions, but we're talking about the ballpark of $500,000. From $5 a day. And here's the part that really gets me: of that total, you would have personally contributed around $73,000 of your own money. The rest? Everything above that? That's compound growth doing the work. That's your money making money, quietly, while you slept, while you watched telly, while you were stuck in traffic or arguing about whose turn it was to do the dishes. You didn't have to be a financial genius. You didn't have to pick the right stocks. You didn't have to time the market or read Bloomberg every morning. You just had to start. And stay consistent. Now, I want to be really honest with you here, because I think some financial content can make this sound too clean. There will be years where the market drops. There will be times where you look at your balance and it'll be lower than it was 6 months ago, and everything in your brain will be screaming at you to pull the money out, to stop contributing, to wait until things settle down. That feeling is completely normal. It's human. And it's exactly the thing that stops most people from actually getting to that $500,000 outcome. Because the math only works if you stay in the game. The compound growth doesn't happen in a straight line. It looks more like a bumpy road that gradually climbs. And the biggest gains tend to come later, which means the worst thing you can do is leave just before the curve really kicks in. But we'll come back to that. I want to tell you something that shifted how I personally think about all of this. For a long time, I thought about investing as something you did to get rich. Like the goal was to hit some magic number, and then life would somehow feel different. More secure. More free. Like there was a finish line. And what I've slowly come to understand, and honestly, it took me longer than it should have, is that the real value of investing small amounts consistently isn't just the money at the end. It's the relationship you build with your own future self along the way. When you invest $5 today, you're essentially making a decision to look after the person you're going to be in 20 or 30 years. You're saying, that version of me matters. That person deserves to have options. And that shift, from thinking about investing as wealth accumulation to thinking about it as self-care for your future self, changes everything. It stops feeling like sacrifice. It starts feeling like respect. Like something you do because you take your own future seriously, not because some podcast told you you're doing money wrong. There's also something psychologically important about building the habit itself, separate from the amount. When you start small and consistent, you build an identity as someone who invests, as someone who thinks ahead. And that identity, once it's part of how you see yourself, naturally grows over time. You find yourself thinking, well, if I can do $5, maybe I can do 10. And later, maybe 20. Not because of pressure, but because the habit already exists. You've already built the muscle. So what does this actually look like in practice? Because I don't want this to be one of those videos that makes perfect sense while you're watching it and then evaporates by dinner time. The most accessible option for most Australians right now is through a micro-investing app, things like Rai's or Spaceship, which let you start with very small amounts and invest automatically into a diversified portfolio. They're not perfect and they're not the only option, but they're genuinely low barrier and they work for people who want to start without needing to understand the entire financial system first. If you've already got a CommSEC or SelfWealth or any other brokerage account, you could also look at low-cost ETFs, exchange-traded funds, which are essentially baskets of shares that track an index, something like the ASX 200 or a broader global index. You invest a small amount regularly, keep fees low, and let time do most of the work. And here's something really important: automate it. Don't rely on yourself to remember every week, or to be in the right mood, or to have a quiet moment to transfer the money. Set up an automatic contribution that comes out on payday, before you have a chance to spend it. Treat it like a bill you pay yourself. The other thing I'd say, and this sounds small but it matters, is to check your balance less often than you think you should. Seriously. Once a quarter is plenty. Checking every day or every week when the market moves just creates anxiety and makes it harder to stay the course. Investing is boring by design. If it's exciting, something's probably wrong. And finally, and I say this knowing it can feel difficult, don't wait until your finances are perfect. You don't need to have the credit card fully paid off, or a 3-month emergency fund locked in, before you start putting away $5 a day. Doing multiple things at once, gradually paying down debt, building a small buffer, and investing, is actually how most real people build financial stability. Not sequentially. Simultaneously, in small amounts. I'm 48 years old, and I'll be honest with you, there are things I wish I'd understood at 25 that I only properly understood in my late 30s. Things about compound growth, yes, but more than that, things about patience and about the gap between what we feel about money and what we actually do about it. And if I could sit down with a 25-year-old today, maybe someone who's just started their first real job, or who's paying off a HECS debt, or who's just trying to figure out how rent and groceries and life all fit together, I wouldn't give them a 15-step plan. I'd just say this: $5 today. Somewhere it can grow. That's it. That's the whole thing. Because the hardest part of building financial security isn't the math. It's believing, when you're young and life feels expensive and complicated and the future feels abstract, that the small thing you do today genuinely matters. It does. It really does. You don't need to have everything figured out. You don't need to be earning a lot or to have made perfect decisions up to this point. The only thing that matters, the only thing, is that you start somewhere. Progress is not linear. Life will get in the way sometimes. There will be months where the $5 goes to something else, and that's okay. The point isn't perfection. The point is consistency over time. Showing up, roughly, most of the time. That's genuinely enough. So wherever you're at right now, whether you're 25 and this is the first money video you've ever watched, or you're 35 and feeling like you've left it too late, or you're 40 and just starting to think about this properly, I want you to know something. You haven't missed your window. The best time to start was 10 years ago. The second best time is right now. Take care of yourself, and I'll see you in the next one.